With the Fed and the ECB raising rates over the last few years, many investors, including myself, have sought to find other forms of return on capital. One such form, which is one of the topics of today's videos, is interest on deposits. Usually, higher interest rates globally from central banks equal better rates for your deposits in financial institutions. We've got a lot to catch up on this video, but there's a couple of topics I want to go through. First, as I previously mentioned, how to get a 4.2% interest rate. Then we're going to go through the dividend income since our last update, which was in November last year. We're going to do a portfolio breakdown, and then we're going to do a new stocks deep dive. Straight into the headline of this video is the interest I'm getting. So this is Trading 212 where I have my portfolio, and they're offering 4.2% interest on euros, which is the main currency of my account. We also have options such as like dollar and pound. For example, in dollars you get 5.1, for pound you get 5.2, right? So this really multiplies. If we're looking at here, I've almost 13,000 euro in cash, right? I'm getting 4.2, so that means I'm getting almost €1.47 daily. And that all time, last month it was just 37.45, and all time almost €100 so far. Now the interesting thing about Trading 212, number one, you don't have to hold the money in the account while you're getting interest. You can take it out. Obviously, you're going to get less interest, but it's not fixed like kind of other financial institutions. You can also see the payments. So the 4.2 is an annual amount, but we're getting the payments daily. So every day I get like €1.50 every day. Now there's also other options, right? So in Europe, you have Trade Republic. In the US, you have the likes of Robinhood, and also in the EU as well, and you have M1 Finance. So I think Robinhood was offering 5% on USD, the same on M1 Finance. Trade Republic were offering 4%, and Revolut, which is also kind of a provider, mainly in Europe, they were offering 3.7%. So you can really see the compounding effect here, right? So they started offering the 4.2, I believe, kind of a couple of months ago, because before that I was only getting like, a couple of cents a day back in February, right? So I think it was around March here, you can see they brought it in, and I'm just been getting €1 nearly every day since then, and that compounds, and then that makes the principal amount larger, so therefore you get more interest then again. So it's a pretty good option if you want to stay kind of liquid, but at the same time also getting a return. And 4.2 is really competitive, right? If this is low risk, now there obviously is risk, and I'm not a financial advisor in this, but 4.2, and you don't have the risk of, like, if you put the 4.2 into a stock and the stock goes kaput, right? It's much lower risk than that. So I think this is a pretty good bet. I would look around to see the best rate for yourself. We're going to move over now though to our dividend payments over the last couple of months. We had a lot of dividend income in this last couple of months. So in this period, which runs from November to now in May, we had $144.84, bring us to a total of $300.51. Let's look at the breakdown of this. Our highest payer was Realty Income, where I have 30 shares, where we got dividends of about $35. Then we had Walgreens Boots Alliance, where I have 37 shares, $21. Altria, 13 shares, $17.93. 3M, 7 shares, almost $18. Coca-Cola, one of our larger holdings with 20 shares, we got almost $15 from. Kellanova, 11 shares, $9.41. And then some of our smaller ones, I'm not going to go through all these, right? But we had T. Rowe, Federal Realty, our ETF, which is our own ETF, Exxon, Intel, which we have now sold, Chevron. And we also had a few of our blue chip stocks. We had Microsoft with 2 shares, Apple 2 shares, and also WK Kellogg's, which we had 3 shares, which is now sold, which I'll go through in our deep dive. So a lot of dividend income in the last while. It's almost half the amount of dividend income that I've received so far. So you can really see the portfolio cranking up on the dividends now, the larger amounts go in. Moving on to the current state of our portfolio. So what I've really been trying to do over the last couple of months is consolidate. Buy some stocks that I think are going to do well, and also get rid of stocks that haven't done so well. So I just want to go through the buys and sells that I've done over the last couple of months since the last update. So I did sell WK Kellogg Co., right, which was the spin-off from Kellanova. The Kellanova stock was the one that held the dividend, and the WK Kellogg was just kind of a new stock for the US. So I sold that off. Another stock that I was long on, and I was also very bullish on, was Intel. So this is one of my largest sales so far, right? So I had 14.8 shares and I sold that for 603. I made about, I think, about a 40% profit, which was about 167 on this. Where I was kind of at with that company is the CHIP Act came in and Intel got a fair portion of that, right? But not as much as they thought, right? Samsung, TSMC got a lot more than Intel was expecting. And really, I think there's better opportunities in the market besides Intel, but this was a solid profit, about 40%, 167. I also sold off Solventum, which was a spin-off stock from, I think it was 3M. I think it was 3M's healthcare division. They just kind of gave you like free stock from depending on how much stock you had in 3M. So I got 1.8 shares. I just sold this straight away because I didn't want to hold it at all. On my buys, so one bet I'm making at the moment is Tesla, which I traditionally don't do because it's not a dividend stock. So I bought 5 shares of that, which was kind of about 1,000. So over the last couple of while, you can see I bought some in January, bought some again in February. I've been adding to this over the last couple of months. I think they're really down in the dumps at the moment, but there's going to be a turnaround on that end. I also bought some more S&P 500, so my ETF. So I've been buying that kind of since December, adding to that, and we'll kind of look at that in total as also. And Realty as well. So I bought 2 shares of Realty over the last couple of months. And I also bought Altria over the last couple of months. And my biggest one, which was literally this week, or I think it was last week, I bought 15 shares of Starbucks for about 1,000. And we're gonna go through that in depth in a minute. For the first time as well, I wanted to showcase my G sheet of my portfolio tracker. Now, it's not just the portfolio, and this is also kind of my cash holdings where I'm getting interest on. So up the top here, we have our total value of the portfolio, which includes the cash outside of the portfolio we track on the channel. So I have cash, about 54% of the portfolio, about 13,000, dividend stocks, 8.5, ETFs, almost 1,500, and the growth stocks are Tesla there. So I guess what I'm trying to get at here in the totals is if we look at all of these of how much I'm getting, it's almost 1,000, right? So I'm making almost 1,000 a year from this portfolio so far, and it's only growing, right? I also have the breakdown of all our positions and what I want to do with them. So I'm going to go through these individually here now. So from the largest at the top, so we've Realty Income, which I have 1,600 of, and has a really good dividend yield at the moment of 5.58. And I'm getting $90 a year from that. So I want to buy more of this. Coca-Cola is similar, second biggest holding, a decent dividend yield, 1,200. I'm getting about $40 a year from this, and I want to buy more of this. And then we have 3, right? So we have Starbucks, Microsoft, and 3M. So Starbucks is my newest purchase, and we'll have a look at this in a minute on the Trading 2 and 2 platform. So they really went down in the dumps in the last quarter, because they basically, the interview with the CEO was terrible. They kind of missed on their figures. They were saying they were going to grow. They really didn't grow all that much, and they were actually down in most of their segments, particularly in China. So I think it's a good opportunity to pick this up at the moment. So I bought about 15 shares at 1,100. The yield is decent. I kind of want to maintain this. I'm not really too interested in buying too much more unless it goes down. I want to see where this goes, if we can turn a nice profit from it. One of our other mainstays is Microsoft. So we have $900 of that. The yield is pretty bad, right? But it's a great company. I think I'm up about 50% on that. So I want to maintain that. If the price goes down, which I don't really see it is, or will be, I want to maintain that. 3M I'm maintaining as well. I'm kind of seeing where this goes. I had $700 worth in there, and that was paying me about $46 a year. So we have Walgreens and Kellanova. Now both of these I'm looking really to sell. So I have about 1,200 between the two of these. So Walgreens is actually my worst performing stock, and we'll have a look at that in a minute on the platform. The yield is pretty good, but the return has been shocking. They're not making money. Their net profit is terrible. Kellanova, they spun off the WK Kellogg, as I was looking at a while ago, which reduced their value. I kind of bought this because I wanted to diversify into more of a outside of the US. So I'm looking to sell that as well if I can turn a profit. Then we have a couple of our bigger ones. We have Altria, Apple, T. Rowe, Federal Realty. So Altria we have 570. and we're getting $51 from that. The yield on this one is crazy, so I really think I'll pick up some more of that. We have Apple, one of a mainstay as well, kind of a bad yield, not known for that, but it's a solid stock. T Rowe, I have almost $400 in, 4.45% $17 a year. Federal Realty, we have $300, $14 a year from that one. And then we have Exxon and Chevron, which are two of the oil stocks. So I kind of want to maintain Exxon. The return has been pretty decent on that one, but I'm looking to sell Chevron. I'm kind of seeing where that looks out. I don't really have much in between both of these, only about $400. Overall here, I also kind of calculated, so the value of the portfolio, how many shares I have back into euro. The average return is 4.13%, so I'm getting $378 a year essentially from this portfolio. Down into the ETF category, I have the Vanguard S&P 500, our VUSA, which I've been trying to diversify into to have a bit of a safer bet, right? So I've about, this is in pound, right, because it's on the London Stock Exchange, but I've about €1,400 in that, which is giving a 1.27% return, which, you know, is not great, but the growth is pretty good. I think I'm up about $100 or so on that. And then in growth stocks, we have Tesla, which I have about, I think I put about 1,000 into it, so it's down at the moment, but I think it's going to turn around. I like what Elon is doing, where he owns the charging network in America, essentially, which is going to pay dividends in the long term. I think, I've had this a couple of times, and I've kind of pumped and dumped it. I bought it, say put $1,000 in here, turned around, and it's at its stock level. Really, it's quite cheap at the moment. So what we're going to do now is we're going to look at a couple of stocks that I'm looking at adding. So I did already add Starbucks. I'm going to look at JP Morgan Chase. I'm thinking about adding that, and then either Visa or MasterCard, and maybe Nike. I'm going to start with Starbucks on the platform, just to kind of explain why I'm buying that one. So back over trading 2 and 2 now. So I bought Starbucks last week because it, as you can see here, even on the max, or if we even go to 3 months, it after earnings it dipped. I think it was like 20%. So it was up here at $88, and it came down to, where was the lowest? It came down to like 72, and I bought it 73.60. So if we just have a quick look at their kind of metrics and stuff, we can see as well I'm actually already up on this since I bought this, but not by much, right? So I'm not expecting anything crazy here. So they're pretty decent yield, 3%. Obviously they're a pretty large company here with 35, almost 36 billion. Earnings per share is 360. So a lot of the metrics I look at, right, if we come in here to financial strength, is I'm looking at the payout ratio to see how big or bad that is. 60% I think is okay really for a company this size. And then their margin, if we're looking at their net profit margin over the 5 years, right? So I always look for double digits here, so they always kind of have to be over 10% for me to buy them. And you can see these guys are almost 11%, and they're kind of going up as well. Growth wise, what we kind of want to look at is their EPS growth over the last couple of years, so 65%. And scrolling down here, their dividend growth was almost 10% as well, which is key for dividend investors like myself. So if we pop back and look at their financials, right? So if we look at their income statement first, and I'm going to look at it yearly first, right? So their net income was 4.2 in 21. It was 3.28 in 22. And 4.12, so pretty solid, right? It did dip a substantial amount from 21 to 22. Probably put that down to pandemic in a way as well. Watering their last one, right, where we can see Q1, you can see here that their net income went down, right, which is one of the reasons why their stock kind of went down in the dumps as well, right? So it went down by about 200 million. Look at their balance sheet. Let me just slide these over, because all we're really interested in is their total assets. So if we're looking at their total assets from 2021, so start off in 31 billion in that total assets, went down to 27, went to 29, right? So back in 21 they were much healthier position assets wise, liabilities wise in total, so 36 and 21, 36 again. So they're not really going up substantially, which is a good sign as well. swapping on over to their cash flow, right? So I think cash flow is really becoming a lot more important for these bigger companies and dividend investors as well. Because if you don't have the cash, you got to take debt. And if you've debt, you have to pay down that debt. Now, debt can be useful, obviously, if you want to kind of reduce your tax burden and, you know, invest into the business and get a better return. Fair enough, right? So if we're looking at their starting line, so the starting line is usually the net profit, or usually it is the net profit from the year before. So in 2021, they had 2.1 on hand. They went down in 2022, and then they only had kind of a small, I know it's 733 million, but a small change in cash, right? So cash really isn't looking good. And what I would advise you to do, and I might do a separate video, is go and look at the interview with Jim Cramer and the CEO of Starbucks to see how much of a disaster really their quarter was. But it's a great buying opportunity. So the next company I had my eye on is JP Morgan Chase. I don't really have any banks in my portfolio. I do have T. Rowe, which is kind of more of an investment firm, but I really do like Jamie Dimon. I do like how he's running the business, and I also like the fact that even though there are banks failing, JP Morgan are picking them up for really cheap, so they're really getting the returns on these banks like Silicon Valley and etc. over the last couple of years. However, the only thing that stopped me from buying them at the moment is they're at all-time highs really with the share price. So don't really want to buy at all-time highs. If they came down to maybe 150 or 160, I would consider it. So let's look at some of their metrics as well, though. So their yield is 2.33, not the best, but you know, still a solid return. Their EPS is $16.06. So if we look at more ratios again, like we did for Starbucks, their payout ratio is really good. Like Starbucks is 60, their payout ratio is only a quarter, 25%, right? Looking at their margins, their net profit is really good as well, way better than Starbucks, 31.34%. That's, you know, that's reflected in the price. That's why the price is so high. Looking at growth, well, so their revenue over the last 5 years grew almost 40%. Their EPS grew almost 22%. Looking down to the bottom, their profit margin didn't really grow all that much, right? So that's a bit of a red flag, only 1%. And their dividend yield did grow 4% over the last 3 years, which, you know, isn't all that bad. So if we pop back and go to their income statements, and we go back to 2021 and we'll close these. So their net income in 2021 was 48, went down almost 10 billion to 37 in 2022, and it's way back up again in 23, right? So that's reflected in the price of almost 50 billion. So if we move over to their balance sheet, so their total assets in 2021 was 3.74 trillion. 22 went down a little bit, 3.67, and then back up again in 3.88. And their liabilities in that time, so that'd be debt and, you know, shareholder payments, etc. So we 3.45 in 2021, 3.37 in 22, and 3.55. So I like the fact they went down year over year, 21 to 22. But then in 2023, they kind of went back up to all-time highs, which isn't the case. I imagine that has something to do with the taking on the, you know, the failed banks like Silicon Valley and etc. So look at their cash flow as well, which is probably one of the more important metrics. So in 2021, they had 213 billion. And then in 2022 went way down as well. So not a big fan of that, right? 2023 though, coming back up again, so they're making a return. So overall, I think if they come down in, I think I have a set price or a reminder here of like 150. So I may look at buying in 150. The last one I'm going to look at is Visa. So we can see that they're pretty much at all-time highs as well at $280. Now, the one thing I will say, and you'll see this compared to the other two when we look at their metrics, is their metrics are amazing. So they do have a pretty small dividend yield. Same with MasterCard. Obviously a very large company, but they just, like if we go into their financials here, we look at their ratios first. So starting off, let's go financial strength. Their payout ratio is 22, so even better than JP Morgan, way better than Starbucks. That is very sustainable, right? Looking at their margins, 52, almost 53%. That's amazing. Almost their net profit margin is almost half. So everything that they're, selling, or well, they're a payment processor, so all the money they make, they're making almost 50% on that, which is crazy. We look at their growth as well. So their revenue growth over the last 5 years is 14%. Not crazy, but still pretty good. Their EPS grew 12% over the last 5 years. What I really want to look at is their net profit margin, 1% over the last 5 years. Not really great. We do see their free operating cash flow growing fairly good. And for us as dividend investors, or most of us probably are, 14.47% is really good. So their metrics are really good. Let's look at their financials. So if we look at their income statements, let's just close a few of these. So if we go 2021, their net profit was 12.31, 22 up 3 billion, almost 15, and up again in 2023. So that's amazing, right? So it's going up by billions every year. Particularly the jump between 21 and 22. What's that? Almost 3 billion. And then from almost 3 again, 2.2 from 22 to 23. Looking at their balance sheet, if we close these ones and we want to look at their total assets, so we 90. Well, we go at 2021. So the 82 in 2021 went up to 85 in 22, 23, 90. So looking good there. Their liabilities, 45 in 21, 49. So that went up. But it's going up on par really with the assets. So the assets are increasing substantially. And it really is in line with their liabilities as well, I think. So their cash flow then, which I imagine from what we saw in the metrics, pretty good. So change in cash, 2021 was 628, 578. So very consistent, and you can see that massive 3 times jump in 2023. So 2023 has been a great year for these guys. So I'm looking at adding these, just like JP Morgan Chase. I feel like they're really high at the moment. I can't remember if I said an amount. No, I didn't. Oh, I did, 200. So they're at 290. But look at this, such a great company. I might buy at higher than that. Like if it was to have a little dump like kind of did there, definitely would buy again. So really that's kind of what I wanted to go through today. I am also potentially going to, if you're interested, I could share this so you guys could use it for your own portfolios. A lot of it is just kind of Google finance equations and a few of my own, and you can change it around for yourself. But yeah, that's all for today's video, and I'll catch you in the next one.